Hi there, Etoro. It is Monday, the 28th of February, and that means it's time to take a look at what happened in the markets last week. So it was another wild week. These horizontal dashed blue lines show 2 Fridays ago, so the end of the previous week, just so it's easier to see what happened. We can see in both the Nasdaq 100 and the S&P 500 that the week closed out more or less at the level of the previous Friday, although that hides the true volatility. This is a pattern that I've spoken about in previous videos. So I mean, we can see this huge green candle, huge red candle in the Nasdaq in the middle of the week. We can also see that from the recent high in November that the Nasdaq fell into bear market territory briefly. So it had been carrying a loss of more than 20%, which is counted as a bear market. And the S&P 500 fell into correction territory. I haven't marked it out here, but both of them recovered on the day that the invasion, you know what invasion I'm talking about, the invasion began. Now, the war has been going on for not very long now, so I think roughly a week or so, maybe, is it 4 days? But you can see the effect that it's had on the Russian economy. The dollar at one point was 44% up versus the ruble from 1 week ago, before the Russian central bank raised interest rates to, I think it was 20%, to put a bottom under that exchange rate, and it seems to have worked, although obviously it's still not looking fantastic. I've also pulled up gold on screen, so this is just, I'm using it as a representative of safe assets that investors run to when there's some uncertainty. So the US dollar is another one. I mean, there are many. I'm not going to name all of the various hedges and safe assets that people rush to, but you can see that its value appreciated a little bit through last week, but not a huge amount, and gold is still stuck in this range. It's been stuck here for a long time. This is very confusing because we have a hell of a lot of uncertainty in the world right now, and also we know that interest rates are increasing, so real rates will be going up, so the price of gold should be increasing, but it's just stuck. So that's quite a head scratcher. I'm staying away from gold for the time being. Now, quite often I start these calls by talking about the Nasdaq 100 or the Nasdaq Composite and the S&P 500, and I think it's probably quite obvious that the Nasdaq 100 is a lot more volatile than the S&P 500, but for passive investors, the S&P 500 is the go-to index for those types of investments. And I'm not sure that style of passive investment is the best way. This is just a personal opinion, by the way. So what we can see is, here I have on screen, and sorry, there are a lot of lines, the candles of the S&P 500 going back to 2001. So that's just after during the dot-com bust. And then the orange and blue lines here are the Nasdaq 100 and the Nasdaq Composite. Now, I have cherry-picked the time frame here a little bit, and that's because I think that when stocks were running up, tech stocks were running up in the late 90s, this was a ridiculous time to be investing so much in companies that weren't making any money. I mean, lots of these companies don't exist anymore. So I'm excluding this period of crazy euphoria. But, you know, for the 2 decades after that, despite the much higher volatility of the Nasdaq 100 and Nasdaq Composite, you can see that your returns, if you had invested in an ETF or the index itself, your returns from this particular index far outstrip the returns from the S&P 500, which, you know, they aren't bad, but I mean, if you could have made double the money or more, why wouldn't you have? The reason that I'm pointing this out is that volatility, in my opinion, isn't representative of risk, at least not always. You can find good quality companies that are highly volatile, and over the long run, their returns are fantastic. But, you know, you need to be able to withstand those gut-wrenching periods of volatility in order to reap the reward of the returns that good quality companies that are also high-growth companies involve. All right, I just wanted to take a bit of a broader look at the indices too, well, indices and ETFs that I track. So year to date, we can see that the Nasdaq 100 is still in correction territory, although it's staged quite a big comeback from last week. The Nasdaq Composite is hot on the heels. S&P 500 is out of correction territory, but also, you know, it's been a tough year. We're nearly in March, and these 2 major US indices are still in the red. Now, my personal opinion is that when you see protracted periods of big drawdowns because of whatever uncertainty is causing those drawdowns, that you're probably in for a decent return in the coming period. and vice versa. If you've seen a lot of really good returns for a protracted period and people are very happy and making crap loads of money, you're probably in for some pain in the near future. So just try to bear that in mind. Now, the war that's been going on for not very long now is already changing quite a few things, and I think for the better. It's good to get some good news. And these are big changes. I mean, Germany is changing its target to only get its energy from renewable sources by about 5 years, and I suspect that in order to achieve these goals, they might have to reconsider their stance on nuclear power, but that we'll see. They are also boosting their military spending, and this has affected stocks in these areas, so renewable energy stocks and military stocks. That's not the only big country level change that we're seeing. So as an example, we're seeing the Finnish people backing NATO membership, and this is for the first time in the Nordic countries' history, as you can read about here. And Switzerland's decided to not be neutral on this particular issue. So I mean, war is awful, and my heart goes out to the people that are directly affected by it, but it does look as though there are the beginnings of silver linings. Travel stocks have been hit by the invasion, and you can see from the middle of February onwards, JETS, which is an ETF that gives investors exposure to the global airline industry. You can see that it's been dropping more or less since the middle of February. Now, for some airlines, this makes sense. So for those airlines that have to travel over the Ukrainian and Russian regions, they no longer can fly over that area, and so their revenues and profits are going to be affected. But there are other airlines that won't be affected at all. So this is just another example that I wanted to pull up that shows you that the market isn't efficient and it's not always rational. Alrighty then. So last week was also a big week for earnings for my portfolio. So I did put out a post about this. The group of companies that you might know as Booking.com reported a very strong recovery through the tail end of last year, and I think that they're going to do very well through this year. The stock price has been hit in a similar way to jets and airline stocks have been hit, but I think that is temporary and that it will bounce back quite strongly. Alibaba posted earnings that were okay, but I expected that. I'm not sure how many of you have been following Chinese stocks for the past half a decade or decade or so. Baidu went through a big crackdown period and had to change a lot of its business. There were massive adjustments, and it took them a few quarters in order to find their feet and return to being the kind of company that made a lot of money once again. And I think Alibaba, as I've said before, would take a few quarters to make an adjustment. So I think that they're in that period at the moment. We need to continue watching them closely, but I think that they will be fine. Square is one of my favorite youngish companies out there at the moment. They have got a great product, great management team, and they've just been so successful. They've also increased the breadth of service offerings that they have, either through building them themselves or through acquisitions. And the stock price has dropped. I made a mistake, I think, when I called it out here. No, I didn't. So if you look at the share price of Square, it's battled through the past year. So it hit a high in February and it bounced, it dropped and climbed and dropped and climbed. And ultimately it has been in a slow free fall since August last year. And they posted earnings after losing 70% of their share price from the recent all-time high, and those earnings were incredible. Good companies that have a track record of winning usually continue to win in their specific areas. I think that Square's share price will probably slowly continue the march up to $200 in the medium term. I think it's completely crazy that the share price got all the way down to levels not seen since the beginning of the pandemic. I'm not going to go through this in detail. You can read about it on my feed. Overstock is another company. I said here that the price has halved, going from 109 to 36, which is obviously not half. It's a bit of a typo there, sorry. But an enormous drop in the stock price for a company that's fantastic. They found their niche. They're growing very, very well. They're making a huge amount of profit, and they contain a whole other company that the stock market is just valuing completely incorrectly. It's kind of a weird setup because this company is very different to what Overstock actually does as part of their core business. But nevertheless, this is a fantastic company, and it's also bounced quite strongly last week on earnings. And lastly, ᴄᴏᴜᴜ, I've posted many videos and posts about this company. If you browse around my YouTube channel, you'll find other videos that I've made about ᴄᴏᴜᴜ that are a bit more detailed than the one paragraph that you see on screen. But long story short, for the last few quarters, they've just shown incredible growth, and they've said that the growth is going to continue. There's a huge amount of the market for them to grow into, and their last earnings report showed that they had 60% revenue growth year on year. And if you think back through the last year, it's been quite a challenging environment for e-commerce companies, and particularly in South America. But go watch my videos and I talk a little bit more about why. In terms of economic data, there was quite a mix of economic data out of various economies last week. The UK is still just showing strength in many different areas of the economy. It surprises me that investors aren't rushing to invest in the country, but hey ho. But from the economic data that I track for the countries that I watch, growth is looking pretty strong. Inflation looks as though it might start topping quite soon. So I think that we will probably be in a good place for the rest of this year, if certain bad things don't happen. Now, part of the reason that the market has been concerned is that after Russia invaded Ukraine, countries started announcing that they were placing sanctions on certain Russian individuals, Russian companies, and the government. These sanctions will affect, obviously, all of the people that the sanctions are applied to, but also other companies from other countries and individuals from other countries that are involved in the networks with these people somehow. So, for example, a select number of Russian banks will be removed from the SWIFT international payment system. One concern that the market has at the moment is if we lock out a large portion of these wealthy Russian individuals, Russian companies, as well as the Russian government, that we might start seeing liquidity shortfalls in certain areas. And they could be quite large, and the shortfall could be very, very sudden. In that case, we might have to have certain parties step in, and there have been whisperings that the Fed might need to step in and, not taper as fast as they had originally said they would. But I don't think that's very likely just yet. If the war wears on for a bit more, then maybe. But the US is fairly far removed from it. I think we might start seeing it in European countries first, but right now I don't think so. This weekend we also got the annual letter from the OG, Mr. Warren Buffett. I'll zoom in here a little bit, but you can see that over their nearly 60 years of operation, that they have managed a CAGR, compound annual gain, of 20%. So since 1965, 3.6 million% return versus the S&P 500's 30,000% return. So obviously a very successful company. I think everyone knows that, given the number of Buffett quotes that we see on Etoro and Twitter and everywhere else all the time. I would encourage you to read this letter. It's good information for investors. It's also good information for anyone that might be interested in business in general. And also, Warren Buffett is quite a funny guy. So, he's not Jerry Seinfeld, but these letters aren't as dry as you might expect them to be. Alrighty, what about this week? So this week is really heavy in terms of PMIs. I'm watching data out of China very closely to see how the various forms of stimulus are beginning to reflect in the economy. But you can see PMIs are coming out for quite a few different countries, and we'll get the CPI number out of Europe, or the European Union. But what the market is really waiting for is the Federal Open Market Committee meeting that is probably going to happen in the middle of March. So this meeting is the one where they expect announcements about interest rate increases, and also where we will get details about the Fed's policy for the coming year. Now, we might see some volatility in the market based on whatever news we get out of this meeting, but so much negativity has been priced into the market that I suspect any volatility would be to the upside. Something scary that has been going on is, Putin has very openly spoken about their nuclear capability, saying, their army is smaller than NATO's, but, they've got a pretty good nuclear arsenal. And now he's put their nuclear forces on special alert. Is this just a negotiation tactic? I don't know. I don't think anyone knows, but, the internet will be full of opinions about whether it is or isn't. Nevertheless, it is a very scary potential possibility for Europe and the world. But if it does come to nuclear war, I don't think we're going to be worrying very much about the stock market. And I spoke about silver linings, or the potential silver linings, earlier. Not too long ago, Ukrainians and Russians met at the Belarusian border to talk about the terms of a potential ceasefire. I'm not very optimistic about this, but it is the beginning of the process. It's going to be a very political process, and there's going to be a lot of egos involved, a lot of emotion. I don't think it's going to be solved today, but the silver lining potentially is that this process has begun, and hopefully there's a diplomatic way out of this war, and that, you know, the bloodshed can stop. This week and for most of the remainder of March, we will see earnings reports continue to come out, although the pace of them will start slowing down. The earnings season is beginning to wind down. And that's it for this week. I apologize for not creating a video last week. I was traveling, and I hope to get another stock analysis video out this week. I got some really good feedback on the last one. I'll speak to you soon. Have a great week. Goodbye.